My name is Arthur Halleran. I'm the CEO of Trillion Energy, which is an oil and gas producer in Turkey.
Arthur, thanks for coming aboard, and thanks for coming to share your story. And you're also going to educate us a little bit about what's happening out there in the wider market. Obviously, I think people are looking at the Russia-Ukraine situation and wondering how companies operate in that environment. But why don't we kick off first and tell people a bit about you? What's your background relevant to what you're doing now?
Yeah, so I have about 42 years experience in petroleum geology. I'm actually a geologist, and I have a PhD in petroleum geology, and I'm a co-founder of Canacol Energy, which is the largest gas producer in Colombia, and also Rally Energy for Scimitar in Egypt, and a bunch of other companies in Africa. So I have a good base in international geology.
Oh, you must know Dave Winter then.
Yep.
Yep. There we go. Okay, there's a connection. So tell me a little bit about the rest of the team that you've got working here with you.
And the team I have in Turkey is the original management group that was involved in this project since around 2000. My CFO is David Thompson, who has 30 years also in experience in oil and gas. The last couple are with Dragon Energy. And I have Barry Wood, which is a geophysicist, PhD, and about 40 years of experience.
Okay, I mean, given the state of the oil and gas market in recent years, it's been a difficult time. It's come back. COVID has set a few things in motion, not least of all, oil and gas prices start, getting back up to, previous levels. Can you tell us what exactly you have got planned? Because it's been going. This company's been going a while. There's lots of money invested in previous incarnations. What are you working with today?
Yeah, so we have an offshore gas field in Turkey, and in Turkey there was always a high price gas environment, and so pre-2020 COVID, we went through the process of getting a reserve report, getting everything ready to list on the Canadian Security Exchange, and we did that on February 2020, and then COVID came, and all the commodity prices, as you know, crashed. And then we've been working quite, hard to get things going. We re-domiciled into Canada this January, and then there was the invasion of the Ukraine by Russia, and then the gas prices in Turkey, Europe as a whole just skyrocketed. And so that's set us into a really good position here.
Right, and obviously where you're at, Matt, you're sort of sub 100 million market cap company. The shares have had a 50% increase this year. It bodes well for the sector as a whole. But I'm sort of interested in sort of where you're coming from in terms of your financial position. I know you've raised some money recently. Where does that put you in a good place? I mean, what are you going to do with that capital? Is that just firming things up, yes, or was that allocated for drilling?
Yeah, so the company was in a rough position when we first. We actually purchased the asset in Turkey. It was a distressed sale. We picked it up on pennies on the dollar, but there was no reserve report. The $600 million asset had a zero value, so we were really struggling 6 cents, 7 cents, and then with this. But we then got a reserve report, so we had a huge value attached to the gas. So we had this big facility. So then we went and started getting the project going. And then after we re-domiciled, we started to do a fundraiser, but we did a non-brokered private placement because initially we wanted to get $5 or $6 million because there's only one rig in the Black Sea that we can use to drill our gas wells offshore Turkey. And we initially started off, we thought we'd try to raise 5, but then it went to 10, and we oversubscribed to 18 million Canadian because there was such an appetite now for natural gas in this part of the woods. And so what that money actually has now done is it's allowed us to secure the rig, pay some long lead items because of with the COVID, there is a supply chain issue, and we want to capture the high price of gas. So we've organized it to move the rig to the offshore locations by July 2022. And so with that initial money, we have secured the rig. We've got the long lead items. We just signed the definitive contract with the rig, and everything's set for spud date July, August this year.
Okay, and just so I understand the economics for that, so you've raised some money. How much of that has been allocated to this one asset? Because you do have some others in the portfolio elsewhere, don't you?
Yeah, that's correct. So I've learned to focus. So what we have here for this asset is we have 4 offshore platforms, a subsea gathering system, onshore facility that to rebuild today would be like $600 million. They're in really good shape. They discovered 8 gas fields, but they only put 4 of the gas fields on production since 2007. And so the whole process now is to bring those other 4 gas wells. We're going to directionally drill from the platform to those pools. So there's no subsea tie-in. It's a lot faster, a lot less money. So we have those 4 gas pools that we're going to be put into the production. In additional to those 4, we have another 10 development locations. So we could, the first ones are reserved. So we have a GLJ third-party reserve report, and the other one is a development location. So there is no exploration, there's no mystery. And we could be drilling there a well every 40 days until 2024. And additional to those, there are 13 exploration on the block. So to answer your question in a long way, every dollar I invest in the SASB, I will get immediate return in a couple of months because of the high gas environment, the need for natural gas. I have a large project in Bulgaria that we have a resource report that's a TCF. It's unconventional. We were doing an environmental evaluation, but again, we had to put that on hold because of COVID. Now Bulgaria's had their gas shut off. I've had many people now or companies contact me on that. So for Bulgaria, the best thing for the company would be to farm it out, get an industrial player so that we could get some return for our shares, because that project won't produce gas for 2-3 years. So the best thing is focus on our offshore Black Sea.
Okay, so Bulgaria farmed out, and you raised the point. Obviously, their supply's been cut off. So that is there any conversations happening at the moment, or how close are you to agreeing anything there?
Yeah, so their gas was shut off here last week because they won't pay for the gas in rubles, and in Turkey also. So for Turkey, they import 90% of their gas, and predominantly half that gas also comes from Russia. And Turkey is a NATO country, right? And so we're getting into an area where you have a large competition from Europe for gas. At the same time, Turkey, Bulgaria, and Poland, like also Poland had their gas shut off. There's going to be a really tight market for the next 2 or 3 years in this area.
Yeah, I mean the geopolitical scene there is very good for companies like yourself in this position. It's also quite good for gas prices, one suspects, if you're a producer of gas. We'll come on to that in a second, because I wouldn't mind getting an update from you on that one. But just back in with regards to your focus, right, on the Black Sea, you say that you can drill, every day until 2024 because you've got the information that you need there. So, can you just kind of list out what exactly did you buy again? What did you get in terms of the data rather than the physical asset?
So for the SASB, we have very, very good 3D seismic. The 4 pools, actually it's like 5 pools, but there's only, forget the reserves, those 4 pools that were not produced were drilled, tested, mapped, everything. They were just never put on production. And so the data is very high quality. So we have logs and so on. For the development locations, the same thing. We have very good seismic. And the reason why they're development locations is they're just slightly too far from the control, the data, or there's a small little fault block. But in the seismic data, they have exactly the same response of the 4 pools that we have produced. And so those ones, like I say, there's no expiration for those projects. They are there. The data is very good. We have a GLJ from Calgary, which is an engineering company, a third-party reserve report on those. And then the development locations, it's a resource report, again, by those
Right. Okay. So given that data, what is the, and I know it's shallow drilling, etc. And you've just, I know, saw the release with regards to the rig service. It's one rig. With that data, does that mean that you are 100% going to hit each time, or is it it's 4 out of 5? I mean, what's average success rate are you looking for? Given I guess you said the payback's quite quick, but that must be based on some assumptions.
Yeah, the payback is just a matter of months, especially like right now we're getting $18 US an MCF, and all my economics and so on, I ran at $8.50 to $9. It's just that the price would change too much. So I've just left the third party price deck the way it is. For success rate, based on the past history with the AVO and so on, it was an 80% success rate. For the program A, which I call the reserve program, which are 5 wells and 2 recompletions, that gas is there. It is approved, so there's no issue with that. The development locations, which are 8 wells and then also 2 recompletions, there's no such thing as 100%, but it's about a 90% to a 50%, and that's the numbers that the engineers use. Really, the only risk you have is mechanical risk, like you have an issue with a well and so on. So for this program A and program B, the gas is there.
Right. Okay. You've raised a chunk of change recently. I guess what I'm trying to get at is like, when does this come self funding in that sense? So it's a quick payback, but with one drill, what is the cost? What we know the payback is quick, but what's the net back to you on a, I don't know, monthly, quarterly, or annual basis per hole?
Yeah. So the price of the wells range from, depending what we do, 3.5 to say 10 million, but the average price would be about $9 million dollars versus 12 million if we didn't drill from the rig. The net back per MCF, so our op costs are about 21 cents, because what we've done is we have a monthly fee. So our partner is TPAO, and they operate the processing facility. And so we pay $100,000 a month, regardless of the amount of production we have. And so once we get up to a decent production, it's 21 cents an MCF. And then we have 12.5% royalty. So basically, we net back on $9. We net back about $6 an MCF. And then at $18, we're netting back like $13 an MCF, right? And then the per well production. So the way it works is that each well will be capable of about 3.5-4 million cubic feet per day. And again, using the deck that GLJ did at $9. By the time we finish program A, which is the 5 new wells and the 2 recompletions, we will be making about $3.7 million US per month free cash flow after everything. So at $18 an MCF, that's double that. So now you're talking like 7. And after the development wells, we're up to, I think it's like 7.6 million US. That's a month, right? And so you double that at $18. So when you wanted to come up like monthly cash flow before all costs and so on, if there's such a wide range, we've actually quit trying to calculate it. But so an example, if you're making $15 million a month, times that by 12 and minus a few of the costs, you're up as 120, 150 million US a year revenue for this project.
Yeah, absolutely. And what's we know the field size. So how quickly would you want to expand the production in the field, given the cash flows coming in? I.e., is the money going to go back in the ground? I mean, what do you do with it? You've got a couple of other projects elsewhere, as you say, one which may be farmed out. How do you intend to spend the proceeds? Assuming everything goes well.
Thanks for jogging my memory, because that's a very good point. So we've raised already 11 million US, and that has got the project on the way. That's secured a rig, that is paid for all the engineering for the wells and so on. And now we're trying to get another 11 million by maybe another equity or debt raise. And for the first project, the first program A is about a $23 million US for our percentage. So with the 11 we have and an additional 10, with the cash flow that we will get from the wells, we'll be able to then continuously drill from our own revenue, because we worked it out that for the rig and all the supporting costs, it's about 3.2 million per month. And by the time we finish program A, which we will fund, we're already making that per month. So then we can continue to drill and do the other 10 locations. So for the initial $23 million, we're going to be able to do a $74 million program. And that, what I'm telling you, was calculated at the $9 MCF, and now we're at $18. And the reason why I'm not a promoter, I'm a technical guy. And I always say, look, if people can see it's going to fly at $9, I'm not going to run out and say, okay, I'm going to redo all my calculations, have a fantastic presentation to say, look, here's all the numbers at 18. They're smart enough. They know if it flies, good economics at 9, at 10, 13, 18, it's just stellar.
Yeah, no, I'd like that attitude. I prefer that attitude to the promotion of what's gone on in the last, 3 months or so. It's the kind of, the moving average is going up, but let's keep calm about it. Right. So that's on the money side. Can we talk about you've got another onshore project, have you not?
Yeah, that's correct. So and I always forget, because the SASB is such an opportunity to create such cash flow that I can do a bunch of other work. But we also have an oil field in Turkey, and we're producing, and we're probably making now at the price $5 million US a year in revenue, and that pays for all the Turkey office, because I have 12 staff there in Turkey, and my head office is actually in Turkey. And so that is a low decline, long production oil reservoir. It's kind of like we have in Canada. It's a high water cut, and it's just a water recycling exercise. And so that's got another 10, 15 years. Yeah.
Right. Okay. But so that's a kind of ATM, as it were, a kind of cash machine to basically cover kind of G&A and any other kind of exploration work across the group. So I can see why you want to focus on the SASB thing. Can we talk about specifically about the deal there in terms of what they do, what your expectation of them is, what their expectation of you is, and where this thing goes, because both sides will be producing cash. Giving both sides different options as to how they choose to proceed. It's a very strong environment for oil and gas. And there's been a lot of distressed assets out there. Perhaps people who haven't been able to raise capital. So what's your impression of how that relation looks like going forward?
So like for our company here.
Yeah.
So not only do we have all this development, reserves and development locations on our property. Like I say, there's on our property that we own, there's no more, we don't have to get permits and so on. we actually have a whole series of exploration targets. So they're like a stratigraphic target. So it's like an old river channel that's filled with sand. They've never been drilled. They have exactly the same seismic response. They're exactly the same sand. In my 40 years experience, when I look at something like that, I say that's definitely seeing gas saturated. It's never been drilled. And so with the development, the reserves and the development location at $9, we estimate it's about a 250 million NPV when we start putting the right recovery factor in it. So with the price increase, you're talking like another 500 million, a total $500 million US, our percentage. This exploration target stratigraphic would give us the same amount of gas as we actually have in our structural ones that we have produced and we're aiming for. So now that's going to add another 400 million. And I'm going to throw a couple of those wells in our B program. And so that's on the block. So just on the block, you have hundreds and hundreds of millions of dollars worth of NPV. Then off the block, so the old history was, why did they drill the structures we have on SASB? Is because in the Black Sea, they thought there was not enough gas generated. And the gas that we produce is called biogenic gas and is produced by bacteria. And it doesn't produce lots of volume. And so it fills smaller structures. With our history in the area for 22 years, we used to have a huge block of land. We have all the seismic, we have tons of reports, anomalies and so on. And there's some fairly good sized structures in there. And in the past time, they thought there was not enough gas generated in the Black Sea source rocks to charge these large structures. Well, now TPAO to the north of us, which is quite a ways, it's 100 miles, they had their huge discovery, two of them actually, and they now have a combination of about 19 TCF of gas. So what that's done is that has illustrated that there's probably thermal generated gas. You can generate lots of volumes, which is a game changer for this area. So now I've gone back through all the maps and the things, and we have these huge, like stratigraphic, structural, that now has the potential to be charged with gas. Where's the story going? Well, I find where you find gas or where you produce gas is where you're going to find more gas. We already have the infrastructure. We already have the data. So I feel I get a less risk, a better return for my dollar to stay in my area that I know. So if I'm looking for other distressed companies for like they have to have something that I feel will give me a better return than that I have in my own backyard that I know very well.
Okay, and it's a kind of interesting point because when I'm looking at all of these distressed companies, they're struggling to raise capital because a lot of the institutions aren't able to. It's no longer their mandate to be able to invest in fossil fuels, right? And likewise for you, if you're producing cash, I guess you can be a master of your own destiny unless you need to go and raise a big chunk of change for an acquisition, say. But if you're not going to do that, then I guess you can work at your own pace and you're not so concerned about the fact that these funds are, well, I guess changing their mandate. I mean, how do you see the market at the moment? Do you think this is as a temporary thing, or do you think that common sense will prevail and realize that we can't do without all of this gas and oil?
I hate to be a bearer of bad news, but we have fossil fuels and we're going to need those fossil fuels for a long time. And natural gas is going to be your transitional fuel for many years. As you can see, the situation we have right now, they say, what happens if it turns off? And they realize our green energy that we have is not going to fill it. It's going to cause, right now, they turn it off, it's going to cause huge pain for all the industry. We're going to have a big economic downturn. And so specifically talking about Turkey has a very large consumption of gas. And we sell our gas to industry. We don't sell it to residential. So any price increase, we get it right away. So with the large discoveries that they have offshore Turkey, they thought, lo and behold, we can now provide all the gas that Turkey wants, but it turns out that it's only going to provide about 20% for 30 years. And they actually did a study to realize that the consumption of gas, natural gas in Turkey is going to increase about 20 to 15% a year as they make more distributions of the lines. And so we're going to be using natural gas for the rest of my lifetime. And I'm 64, right? And it's going to be there because we might be able to wean off heavy oil and that, but natural gas is the next thing as close to green energy as possible.
Well, I don't. I'm not even sure we'll wean ourselves off that quickly of heavy oil either. The cost of energy is a real concern at the moment, and I think there's going to be, as nuclear has seen, there's been a new narrative around that at a need, at a necessity. So it'd be interesting. Can you talk to me about the politics of the region then? Because obviously you've got to. Well, your investors will have to have made a call. You've made a call. Turkey has got some strong connections with Russia. But it is part of NATO. So therefore, I think it's sort of queued up to try and join the EU. The geopolitical tensions are quite high there. So you feel that this focus on this single asset, Turkey, is going to mitigate the risk profile for you? Or do you perhaps, as I know you said you've got enough to focus on, but where's the confidence to say, well, this one asset will be fine in all of this. We don't need to spread our risk by looking at other jurisdictions.
Well, the one thing that I found about Turkey, especially with the royalty and payment and situations in Romania and in other countries, how when you make a discovery, all of a sudden the royalty regimes change or the taxes change and so on, and they want to grab a bigger chunk. This field has been producing since 2007, and there was a part of it when it was producing a lot of gas. We're still producing, and it's to keep the facility and everything going. They never once changed their royalty or their taxes or anything. And making a deal, I find, takes a lot of negotiations. But once they sign the deal, it's set in stone, and they don't change it. Am I concerned about my business in Turkey and the political situation? Well, number one, it seems that energy seems to ride above that or get missed by that. Oil and gas resources and so on in Turkey is actually so small that and the reason that's why we get such a good price, there is no internal price and external price. They set one price and we just go on that price, right? So it's fairly stable. Like it's part of NATO, and it's like a very, very stable place. I almost call it the Texas of Europe, because you have the rules, the regulations. As long as you don't break the rules and regulations, the fiscal regime, they're very friendly for oil and gas. We have an environmental permit that we've done a long time ago, and it's been passed. So we don't have, every time we want to drill now, all these wells we're going to be doing is covered by the past one. There's no opening something new, right? So it's really a good place to do business.
Right. Okay. And okay. No, I agree with it. We've done business there ourselves. So good people. So just finally on this. The potential need for money down the line to kind of get you to the point where you are cash flowing and that you can take control of your own destiny, as it were. Are you going to need to raise more money later this year to kind of plug that gap? And if so, what was the amount that you felt you need?
So we have enough money actually to carry the project to a certain point, like September and so on. But we do want to try to raise money in some form within the next month, right? And that is just because the same reason why when we did the non-brokered private placement, we oversubscribed like the 18. I could have grabbed all the money. There was a demand there. I turned down one offer for 2 million, and it's just I didn't want to cause a huge dilution for my shareholders. But I grabbed enough that when I have this money now, like I've seen in the past where you have a fundraising and they grab what they think is enough. but it's not enough to execute the project. And then it just sits in the bank and they can't do anything. So I grabbed enough that I can do something. If I don't raise another cent, I can still do something, right? And now it gives me, so I can raise $10 million my next time by a loan or equity or 5 or whatever. It gives me a sense of freedom. So once I raise that extra amount within the next month or so, I really do not have to go back to raise any more money. We'll have enough internal cash flow. But to be straight up, if I do a big like offshore, off my block, if I have an exploration project and the wells cost 20 million and I have to do a program and it's a total of 60 million, but my shares are, in the, we can all dream like $2-3 range, I might go out and do another financing, or I might be able to get a large debt instrument because they see my cash flow and stuff like that, right?
Right. I know you got this with pennies in the dollar, etc., and there's been tens of millions spent on this, if not hundreds millions spent on this previously. Did you take on any debt at that point? Did you have to buy any debt, or are you debt free at the moment?
Yeah, we're debt free at the moment. We had a small 500, but we paid that off, $500,000. So we're debt free, and our capital market rate, we're only 75 million US, and I've showed you that at the low range we're at 250 million US. Yeah.
Right. Okay. And so just looking at this next tranche, you mentioned being able to potentially get some debt or part of it as debt. What are the sort of conditions precedent on something like that? Because as a potentially near-term producer, you've showed, or you're showing that it's a low risk, quick return, high IRR, etc. What would you expect that to look like? And therefore, because it's non-dilutory, I guess your shareholders would be very interested in understanding how you generate something like that. So again, have conversations been had?
Yeah. So for the debt instrument, it would be a total non-convertible. It just would be a straight debt, interest-bearing, payable over a certain amount of time. So we've been offered debt, but it would just cause too much dilution, right? And one of our big issues is we're offered too much debt. So they would say, here's $50 million, but we don't need 50 million.
Right. So what do you mean? What do you mean it would be diluted in the sense that you'll be paying too much a coupon on it, which you don't feel you need to at this time?
Yeah. So in the early days when our shares weren't doing so well and we didn't have this extra money, we had companies come up to us and say, look, we'll give you $25 million or $30 million, but then they have these little clauses in where they can convert some to shares, and it goes back and forth, and then they can manipulate your share price and lower it down, and then they can then convert to shares at a lower price. And I just thought, I don't need any of this. I had enough dance floor that I could continue to dance and try to raise some more money.
There you go. The fun and games of the finance world. Well, Arthur, look, just as a first run through, I really appreciate you coming on and talking to us. Looks like an exciting project. You've got the money to do what you want to do, and obviously, if you go and raise some, sounds like you've got the smarts not to get caught out. So I really enjoyed that. And if you want to come back on and maybe get a little bit more technical with regards to the drilling program, now that you've got the drill rig contract sorted out, I'd be delighted to see you again.
Okay, I'd like to say one more thing when we talk about the price of energy and so on. I just read an article this morning that the price of beer is going to increase in Germany because there's going to be a shortage of bottles, because it's costing too much for natural gas to make the bottles. So even beer drinkers are being affected by the price of gas.
And that's a disgrace. I just need to say that.
Okay. Thank you very much for the chat and your time.
Cheers, Arthur. Appreciate your time today. Thank you.
Okay. Bye.